Hello aspirants and welcome again to Legacy IAS Academy. In this lecture, we continue with our detailed Indian economy PYQs analysis series. So in today's lecture, we are going to look at the banking and banking regulation. Now, banking, if you take as a single comprehensive topic in the last 11 years, that is 2015 to 2025, there has been around 45 questions. However, this banking we have broken down into multiple subtopics, like for example, banking and banking regulation, then you have monetary policy, then you have the economy or the payment ecosystem, so on and so forth. So by bifurcating them into four different components, you will have lesser question in each of that component, but the entire thing together forms the banking system, which has a total of 45 questions in the last 11 years. That means there will be around 4 questions every year from the banking chapter that you have. So let us get started with the banking and banking regulation PYQs. Now, with respect to this particular topic of banking, you have around 18 questions that have been asked in the last 11 years. That means roundabout 2 questions every single year is being asked from banking and banking regulations. So, or banking regulations, yes. So let's get started with the very first question. So the very first question asks, the term core banking solutions is sometimes seen in the news. Full stop. Which of the following statements best describes or describe it? Now, what is a core banking solution? This is a very basic concept of the banking chapter. It's there in our static book as well. So what is this? So it's an easy question as such, right? If you have attended, in fact, almost all of the question except for certain questions which are related to the current affairs, you would realize almost all of the questions can be done only from the class notes that are there. So what is this core banking solution? Now, core banking solution is basically a concept wherein the different branches of the bank are on the core banking solutions network. That means all the branches of the bank are interconnected. That means if you go to any of the branch to make any of the changes in your bank account, it can be easily done and done in real time. That means a change in one branch is going to reflect changes in all the branches, right? So because of that, what happens is every time to make any kind of change, you don't have to be going only to your home branch or the branch where you open the account. You can simply visit any branch of that particular bank, no matter where you have opened the bank account. As a result of which, if you want to make any changes, it can be done easily. The need for going to your home branch is completely taken away. That is the concept of core banking solution. So now, having understood this, let us see the statements with respect to it. Statement 1, it is a network of banks branches which enables customers to operate their accounts from any branch of the bank on its network regardless of where they open their account. Absolutely right, that is correct. The statement 1 in fact is the classical explanation of core banking solutions network. So statement 1 is correct. That means option B is gone. Statement 2, it is an effort to increase RBI's control over commercial banks through computerization. Absolutely incorrect. It has nothing to do with RBI's control. Statement, so when 2 is wrong, so this option is also gone. Now let's look at the third statement. It says that it is a detailed procedure by which a bank with huge non-performing asset is taken over by another bank. It has nothing to do with the NPAs or the merger or the overtaking of the banks. So statement 3 is also incorrect. The correct answer here is option A, that is 1 only. Let's move on to the next question. The next question is about the establishment of the payments banks, which were actually established for financial inclusion. Remember that? In fact, they have mentioned that in the question itself. The question says that the establishment of payments bank is being allowed in India to promote financial inclusion. Full stop. Which of the following statements or which of the statements are correct in this context? Statement 1, mobile telephone companies and supermarket chains that are owned and controlled by residents are eligible to be promoters of the payments banks. Yes, that is absolutely right. In fact, they were allowed to be the promoters because they already have a huge subscriber base which is going to help them operate their payments bank. And these people who are already the subscribers would act as leads, or potential clients for this payments bank. So statement 1 is absolutely right. That means option C goes away, but still 3 options are remaining. Let us look at the other options. Statement 2 says that payment banks can issue both credit cards and debit cards. No, they cannot issue credit card as such. So 2 is incorrect. That is why this is incorrect. This is incorrect. The correct answer will be B, 1 and 3. But still, let us have a look at the third statement as well. Payment banks cannot undertake lending activities. That is actually right. They cannot undertake lending activities. They can invest their money in the government securities. So statement 2 was wrong, 3 is correct. So the correct answer here is B, that is 1 and 3 only. Let's look at the next question. Which of the following statement best describes the term scheme for sustainable structuring of stressed assets recently seen in the news? So the scheme for sustainable structuring of stress asset. What are stress assets? Stress assets are the ones on which there will be no payment of either the principal or the interest for more than 90 days. It becomes a non-performing assets. Now these non-performing assets can be classified into different kinds of stress levels, right? So they are basically the stress assets. So the government has brought in a scheme for sustainably structuring the stress assets so that many or much of or as much as possible the amount could be recovered. Let's look at the options. Option A, it is a procedure for considering ecological costs. No, nothing doing. It is related to the non-performing or the stress assets in the banking system. Option B, it is a scheme of RBI for reworking the financial structure of big corporates entities facing genuine difficulties. Yes, that is what it is. But let us look at the other options. It is a disinvestment plan of the government regarding central public sector undertakings. Incorrect. This was incorrect. This is incorrect. It is an important provision in the insolvency and bankruptcy code recently implemented by the government. That is also incorrect. The UPSC gives you this option because in 2016 only this particular thing was launched. So you may think it was in news. So this is a possibility, but that's not the case. It is related to the restructuring or structuring of a debt in a way that most of the money or as much as possible the money can be recovered. So it is option B. It is a scheme of the RBI for reworking the financial structure of big corporates entities facing genuine difficulties. Let's move ahead to the next question. What is the purpose of setting up of small finance banks in India? Remember, Payments Bank as well as the small finance banks both were established for financial inclusion. Let us have a look. Statement 1, to supply credit to small business units? Yes. To supply credit to small and marginal farmers? Yes. To encourage young entrepreneurs to set up businesses, particularly in rural areas? No. That specificity as such is not existing over here. So statement 1 and 2 is right, but statement 3 is incorrect. So when statement 3 is incorrect, we know this, everything is incorrect. So the correct option here would be A, 1 and 2 only. If you only know that this is incorrect, you can still get the answer. But this is a very straightforward. In fact, Payments Bank and Small Finance Bank were launched just round about that time in 2016. So 2017, they asked you the question about that. Let's move ahead. This question asked in 2018 about capital adequacy ratio. Consider the following statements. First, capital adequacy ratio is the amount that the banks have to maintain in the form of their own funds to offset any loss that the bank incur if the account holders fail to repay dues. That is exactly the definition. Capital adequacy ratio is the minimum amount of money that you need to keep aside in order to address the losses or the payments which will not be repaid back to you. Basel norms had set the standard. Basel norms 1 talked about capital adequacy ratio to be 8%. When capital adequacy ratio was kept at 8% by Basel norms 1, RBI kept it at 9% for all our scheduled commercial banks. In Basel norm 2, the percentage remained the same. But in Basel norm 3, the percentage of capital adequacy ratio requirement was increased to 9.5%. So the RBI also increased it to 9.5%. And the Basel 3 norms need to be followed not just by the scheduled commercial banks, but also by the non-scheduled commercial banks as well. Remember this. Basel Norm 1 and 2 RBI enforced only for the scheduled commercial banks, but the Basel Norm 3 was enforced for both the scheduled as well as the non-scheduled commercial banks. And what is the capital adequacy ratio? Minimum amount that requires to be kept aside in situation wherein you are incurring losses because people are not paying you back. So statement 1 here is absolutely right. Second, CAR is decided by each individual bank. Absolutely not. As I told you, it is basically enforced by the RBI, and RBI decides how much percentage it should be. RBI takes the hint or cue from the Basel norms because we are a party to the Bank of International Standard, which comes up with the Basel norms. However, it's the RBI that decides, because remember, in Basel Norm 1, the Bank of International Standard said 8%, RBI kept it at 9%. So RBI enforces the Basel norms, but it can modify certain things as and when needed. So it is the RBI that sets it, and of course not the individual bank. The regulator is the one who will do that. So the correct answer here will be A, that is 1 only, because statement 2 is incorrect. Let's move ahead. Again, another question in 2018. With reference to the governance of public sector banking in India, consider the following statements. Statement 1. Capital infusion into public sector banks by the government of India has steadily increased in the last decade. No, that is not the case. That means from 2008 to 18 or 8 to 17, it did not steadily increase. It was there, but it dipped, it increased, then it dipped. So there was fluctuation. It did not steadily increase. It is a factual information. So first statement is incorrect. Statement 2, to put the public sector banks in order, the merger of associate banks with the parent State Bank of India has been affected. Yes, that was done. Merger of the banks was done. So statement 2 here is actually right. That means option B, 2 only. Now this was very factual in nature. Let's move ahead. 2018, again another question, again something which is again factual in nature over here. Question says, what was the purpose of inter-credit agreement signed by the Indian banks and the financial institutions recently? So again, current affairs related question. Option A, to lessen the government of India's perennial burden of fiscal deficit and current account deficit. Let's see. To support the infrastructure projects of central and the government, state governments. No. To act as independent regulator? No, absolutely not. Not independent regulator. You have RBI already. Option D, to aim at faster resolution of the stressed assets of rupees 50 crore or more which are under consortium. Absolutely right. This agreement was with respect to faster resolution of the stressed assets amounting 50 crore rupees or more. That is what the agreement was all about. So all you need to know is what the agreement is all about. Let's move ahead. Next question asked in 2019. Again, a very factual question. The question asks, the chairman of the public sector banks are selected by the option A, Banks Board Bureau, B, Reserve Bank of India, C, Union Ministry of Finance, D, management of the concerned bank. This is incorrect. The concerned bank does not. Union Ministry does not. RBI does not. It is the Banks Board Bureau which does. Okay. Again, a factual question. Next, 2019. Again, the service area approach was implemented under the purview of the lead bank scheme. So the government had come up with the lead bank scheme, and under this lead bank scheme, there was a service area approach that each lead bank is going to cater to a particular region or a service area. Let's move ahead. Again, 2019, factual, but I would say conceptual. If you have the understanding of asset and liability, you should be able to answer this. This is not, I'm not going to call this as factual. Which of the following is not included in the assets of a commercial bank in India? That means which of the following does not form the asset of the bank? So see, the asset for the bank is nothing but the loan or the credit it gives to the people. Remember that. Whereas if you deposit money with the bank, it is your asset, but for the bank, it is a liability. So let us have a look. Advances, it is an asset. Investments, it is an asset. Money at call and short notice that it gives, it is an asset. So what is not an asset? The deposit. The deposit for the bank is a liability. It is a liability for the bank. When you deposit the money in the bank, for you it is an asset, but for the bank it's a liability because the bank has to pay it back to you, right? Let's move ahead. Now in 2020, so we have seen in 2019 also there were 3 questions. Let's look at 2020. What is the importance of the term interest coverage ratio of a firm? Now, interest coverage ratio basically tells you how much money the bank has kept aside for covering the interest that it is required to pay. The higher the interest coverage ratio, the better it is. It also tells you the health of the bank. If the interest coverage ratio is high, that means the bank would be in good health and vice versa. So let us look at the options or the statements. Statement 1, it helps in understanding the present risk of a firm that a bank is going to give loan to. Yes. So what is the importance of the interest coverage ratio of a firm? They are talking about a firm. So same for the firm, higher the interest coverage ratio, the better it is. Statement 2, it helps in evaluating the emerging risk of a firm that a bank is going to give loan to. Yes. It helps in identifying the risk, which is present risk or even the emerging risk also. So both statement 1 and 2 are correct. So this option is gone. This option is gone. Now let's look at the third statement. The higher a borrowing firm's level of interest coverage ratio, the worse is its ability. No, it is incorrect. The higher the interest coverage ratio, the higher is the firm's ability. The higher is going to be its ability to service its debt. I hope that is clear. So statement 3 is incorrect. Hence the correct option here would be A, that is 1 and 2 only. Let us look at the next question asked in 2021. Consider the following statements. The governor of the Reserve Bank of India is appointed by the central government. That is correct. So this option is gone. Certain provisions in the Constitution of India give the central government the right to issue directions to the RBI in the public interest. Incorrect. It is the RBI Act which gives the right to the government of India to give certain directions to the RBI. So when statement 2 is wrong, this is wrong, this is wrong. The correct option will be C, 1 and 3. But still, as we always do, let's look at the third statement. The governor of the RBI draws his power from the RBI Act. Absolutely right. The governor draws the power from the RBI Act. So statement 1 and 3 is correct. Hence the correct option here is C, 1 and 3. Let's move on to the next question, again asked in 2021 itself. The statement says, or the question says, with reference to urban cooperative banks in India, consider the following statements. Right. Now remember, every bank in India is ultimately governed or regulated. I should say, it is regulated by the RBI. Urban cooperative banks, they work on no profit, no loss, right? Because they work on no profit, no loss, they give you loans at a lower interest rate. Remember, they give loans only to their members alone and not to others, right? And the members of the bank are basically the owners of the bank. So statement 1, they are supervised and regulated by local boards set up by the states. That is incorrect. The RBI regulates them. So when statement 1 is incorrect, you directly get the answer option B, that is 2 and 3. But still, let us look at the other statements as well. Statement 2 says they can issue equity shares and preference shares. Absolutely. For the ownership, for investment, for liquidity, they can do that. They were brought under the purview of the Banking Regulation Act of 1945 through the amendment in 1966. Yes, that means they are regulated under the Banking Regulation Act of 1949. So the correct option is B, that is 2 and 3. Next, asked in 2021, in India, the central banks function as the lender of the last resort, usually refers to which of the following? So simply they are asking you, what is the meaning of lender of last resort? Lender of last resort means when the banks in our banking system have nowhere to go, don't have anyone else to give them loan or money, they can simply reach out to the RBI. That is what it means, that lender of last resort. You should know the different functions of the RBI. So from this question, you should understand that you should be studying what are the different functions of the RBI. It prints the currency, it's the lender of last resort, it's the bank to the government. It gives loans to the government of India, to the state banks as well. It does the banking tasks for the government of India. It buys and sells government of India's securities, the treasury bills. So all those functions you should know. It is also the custodian of the foreign exchange. All these things we should know. So let us look at it. Statement 1, lending to trade and industry bodies. No, that does not represent being the lender of last resort. So statement 1 is incorrect. So this is gone, but still you are left with 3 options. right? So statement, so let's look at the statement 2. Providing liquidity to the banks, providing liquidity to the banks having a temporary crisis. It does, but does it, this statement is correct, but this is not representing the concept of lender of last resort. I hope that is clear. So statement 2 is also going to be incorrect over here. When statement 2 is incorrect, you directly get the answer, that is statement 3, option D. Let us look at the statement. Lending to the governments to finance. Now let us have a look at the statement 2. So statement 1 is incorrect. When statement 1 is incorrect, this is gone, of course. Let's look at statement 2. Providing liquidity to the banks having a temporary crisis. Yes, this actually means being the lender of last resort. As I said, banks is in crisis, nowhere to go. It can reach out to the RBI. RBI can provide them lending. So 2 is correct. So when 2 is correct, this is gone. 3 is gone, but still 3 can still be correct because 2 options are still left. Let's look at the third statement. Lending to governments to finance. This is finance. To finance budgetary deficits. No, that is incorrect. Financing for the government for deficit financing, that is not. It does. RBI does it, right? That's known as monetized deficit. The amount of money the RBI can print to finance the deficit, or at times can give ways and loan through ways and means advances as well. It does that, but that does not amount to it being the lender of last resort. So 3 is incorrect. The correct option here is B, that is 2 only. Let's move ahead. The next question asked in 2022. Remember, the Banks Board Bureau question was asked previously. Who of the following recommends or selects or elects the chairperson of the public sector banks, the CEO, etc., the top management, has been asked. Now again, similar question is being asked. With reference to Banks Board Bureau, which of the following statements are correct? The governor of RBI is the chairperson. Now this becomes factual. Let's look at the second statement. Banks Board Bureau recommends for the selection of the heads of the public sector banks. This exact statement was there previously, if you can remember, that who recommends or elects the heads of the public sector bank? It's the Banks Board Bureau. Statement 3. Banks Board Bureau helps the public sector banks in developing the strategies and capital raising plans. That is absolutely right. It helps the public sector banks for strategies and stuff as well. So we know that statement 2 and 3 are correct. When we know that, this option goes away, this option goes away. But what about statement 1? The governor of RBI is the chairman of the Banks Board Bureau. That is incorrect. Right, it is basically appointed by the central government. The RBI governor is not the chairperson of the Banks Board Bureau. So statement 1 is incorrect. Hence the correct option here will be option B, that is 2 and 3 only. Let's move ahead. Now we come to 2024. I think there were around 4 questions asked in 2024. Let us have a look at them. Consider the following statements. Statement 1. Syndicated lending spreads the risk of borrower default across multiple lenders. Syndicated lending means there will be a syndicate, multiple lenders coming together and lending the money. When multiple lenders are lending, if there is a default, the risk is going to be spread across the multiple lenders part of the syndicate. So statement 1 is correct. Statement 2. The syndicated loan can be a fixed amount, lump sum amount of funds, but cannot be a credit line. See, it can be fixed, it can be lump sum, it can be a credit line or a series of credit also, it can be there, but cannot be a credit line. Okay, cannot be a. Let us look at the statement 2. The syndicated loan can be a fixed amount, yes. Lump sum of funds, yes, but cannot be a credit line. That is correct. So statement 1 is correct, statement 2 is correct. When both the statement is correct, this option goes away. Right, now you are left with 2 options. In fact, 3 options. Both statement 1 is correct, but statement 2, this option is also gone. So you are left with 2 options, A and B. So both statements are correct, but the thing is, this statement does not explain statement 1. This statement does not explain statement 1. This does not explain why the risk will be lower. The risk will be lower because multiple people are involved. So this option is also incorrect. The correct option will be option B. Both statement 1 and 2 are correct, but statement 2 does not explain statement 1. Let's move ahead. Again, in 2024, consider the following statements. In India, NBFCs, non-banking financial companies, can access the liquidity adjustment facility window of the Reserve Bank of India. This is incorrect. Why this is incorrect? It is for the scheduled commercial. It is for the commercial banks in general as such. So statement 1 is wrong. So this is wrong. This is wrong. Let's look at statement 2. In India, foreign institutional investors can hold the government securities. Yes, they can hold. So statement 2 is correct. When statement 2 is correct, this option will also be going away. The correct option should be D, that is 2 and 3 only. But still, let us look at statement 3. In India, stock exchanges can offer separate trading platform for debts. Of course, there can be separate trading platform. That's not a problem. So statement 3 is also right. Hence, the correct option is option D, 2 and 3. Another question, I think 3 questions were there. So this is the last question from 2024. Let's look at the question. With reference to the rule or rules imposed by the RBI, Reserve Bank of India, while treating foreign banks, consider the following statements. Statement 1. There is no minimum capital requirement for wholly owned banking subsidiaries in India. Incorrect. There is a requirement, minimum capital requirement. Statement 2. For wholly owned banking subsidiaries in India, at least 50% of the board members should be Indian nationals. That is right. There is a requirement of at least 50% of the board members being Indians. So again, it was a factual question. First statement being incorrect. First, you can guess there would be some requirement of the minimum capital. What is this minimum capital? See, when you are opening a bank, you have to have some of your own capital invested. You cannot take the entire money and every money which is on loan, which is not your money, and start a bank. Why? Your money needs to be invested, your very own money. Why? Because when your own money is invested, that is when you will take it seriously, you will be interested in it, you will be invested in it, and you would be looking for it to do well because your money is invested. That is why, remember, if there is a bank, there has to be a minimum capital requirement. Now that capital requirement till very recently was very low. It has been increased, and for different banks, different types of banks, there would be different requirements, but there would definitely be a requirement as such, especially if the banks are commercial banks, whether scheduled, non-scheduled, so on and so forth. There will be a requirement. Here we are talking about foreign. Just because they are foreign does not devoid them of this requirement. Here, when they are foreign banks, they would be foreign scheduled commercial banks. Scheduled commercial banks can be public banks, private banks. Within private, they can be old private, new private, and also foreign private banks as well. Right? What are old private and new private banks? Basically, the private banks existed before 1991 also. What happened in 1991? Liberalization, privatization, and globalization. So private banks existed before also, but the government of India nationalized 14 banks in 1969 and 6 banks in 1980. But there were certain banks which remain private only even after the waves of nationalization. So these banks came to be known as the old private sector banks. In 1991, when we liberalized, privatized, and globalized, we allowed more private sector banks which came in, like ICICI, HDFC. They came to be known as new private sector banks. In 2005, the RBI came up with document talking about having foreign private sector banks as well. So remember, under scheduled commercial banks, you will have the public sector banks, you will have the private sector banks. Under private, you will have the new private and the old private, plus this is private sector Indian banks. In the same manner, you will have the private sector foreign banks as well. So if there is a requirement for scheduled commercial banks for minimum capital, there will be requirement for the scheduled commercial banks, which is public, private, Indian private, new private, old private, or foreign private bank. For all of them, there will be requirement for minimum capital because all of them are scheduled commercial banks. Hence, statement 1 is incorrect. Statement 2, however, is correct. For wholly owned banking subsidiary in India, right, there needs to be at least 50% of the board members. At least 50% of the board members should be Indian national. This is an addition. This is a particular requirement for the foreign scheduled commercial banks. So second statement is right. So the correct answer here is option B, that is 2 only. So this concludes the banking and banking regulation. Total 18 questions, almost 2 questions a year. Now let's go on ahead. Stay tuned with Legacy IS Academy's YouTube channel. Subscribe it and hit that bell icon so you get notified whenever we put a new video. Thank you.